But here is what makes this situation genuinely interesting from a system perspective. While the price was collapsing, physical silver became almost impossible to buy. The Perth Mint suspended wholesale orders. The US Mint halted sales and repriced products 86% higher when they came back online. The Royal Mint in the United Kingdom ran out of silver bars. Indian dealers began defaulting on deliveries. Costco implemented purchase limits on silver bullion. And the Shanghai Futures Exchange saw 27 metric tons of silver drained from its vaults in a single trading day. The price went down. The product disappeared. And most people looked at this and saw either a conspiracy or a buying opportunity. But what actually happened here is far more instructive than either of those interpretations. What happened is a structural event. A moment where two pricing systems that are supposed to reflect the same reality diverged so sharply that the contradiction became visible to everyone. And understanding why this happened, how it happened, and what it reveals about the architecture of modern commodity markets is more valuable than any trade recommendation. So let us do that. Let us understand the system. Not to tell you what to feel about it, but to show you how it actually works. To understand what broke in January 2026, you need to understand what was built over the previous 50 years. And that requires going back to a decision made in 1971 that most people have heard about, but very few actually understand in terms of its mechanical consequences. When Richard Nixon suspended the dollar's convertibility into gold, he did not simply change a policy. He changed the operating system of global finance. Under the Bretton Woods framework, the amount of money in circulation was constrained by the amount of gold in government vaults. This imposed a hard limit on how much credit could be created, how much debt could be issued, and how fast the money supply could grow. After 1971, that constraint disappeared. Money became a function of policy decisions rather than physical reserves. Central banks could expand the money supply as needed. Credit could be created without reference to any tangible asset. And the financial system began a transformation that would take decades to fully unfold. This transformation had a specific consequence that matters for what we are discussing today. It created the conditions for the financialization of commodities. Once money was no longer anchored to physical assets, financial instruments could be built on top of those assets in quantities that had no relationship to the underlying physical supply. A gold futures contract did not require the seller to actually possess gold. A silver derivative could be created, traded, and settled without a single ounce of metal changing hands. The paper market and the physical market became two separate systems, connected by convention but not by necessity. For decades, this worked. The paper market set the price, the physical market delivered the product, and the gap between the two remained small enough that most participants never noticed the difference. But the architecture contained a vulnerability that was always there, waiting for the right conditions to expose it. That vulnerability is simple to state but profound in its implications. The paper market can create unlimited supply, the physical market cannot. As long as demand for physical delivery remained a small fraction of total paper trading volume, the system held together. But if physical demand ever grew large enough to test the delivery capacity of the system, the two markets would diverge. The paper price would reflect trading flows. The physical price would reflect actual scarcity. And the gap between them would become the most important signal in the entire commodity complex. That is exactly what began happening in 2021 and what accelerated dramatically in January 2026. Now let us look at the specific mechanics of what occurred. Because the details matter, they reveal the incentive structure behind every actor's behavior. The silver market has been in a structural deficit for 5 consecutive years. Annual mine production sits at approximately 835 million ounces. Annual demand, including industrial consumption, investment demand, and jewelry, exceeds 1 billion ounces. The gap has been filled by drawing down above-ground inventories, the stockpiles held in exchange vaults, ETF trusts, and private storage facilities. This is not a controversial claim. The Silver Institute publishes these figures annually. The deficit is documented, measured, and acknowledged by every serious analyst in the space. Over 5 years, the cumulative shortfall exceeds 800 million ounces. Think of this as a reservoir. Every year, more water flows out than flows in. The water level drops. For a while, the reservoir looks fine because it started full. But at some point, the level drops enough that the pumps start pulling air instead of water. That is the point where the system breaks, and the evidence suggests we are approaching that point. The Shanghai Futures Exchange vaults held 455 metric tons of silver at the end of January. That sounds substantial until you do the arithmetic. At the drain rate observed on January 30th, 27 tons in a single day, those vaults would be empty in less than 3 weeks. COMEX registered silver, the metal actually available for delivery against futures contracts, has been declining steadily for years. London vaults have seen significant outflows as metal moves to Asian markets where physical demand is concentrated. This is the background condition. The stage was set before the crash happened. The deficit, the declining inventories, the geographic shift of metal from west to east, all of this was already in motion. Then came the trigger events. Gold had surged above $5,000 per ounce in the final months of 2025, driven by three converging forces. Central bank purchasing had exceeded 1,000 tons annually for 3 consecutive years. The de-dollarization narrative, whether overstated or not, was driving institutional allocation into hard assets. And the Federal Reserve had cut interest rates multiple times, reducing the opportunity cost of holding non-yielding assets like gold and silver. Silver followed gold higher, as it historically does, but with greater volatility and greater percentage gains. By late January 2026, silver had risen over 140% from its levels a year earlier. Gold was up 65%. These were extraordinary moves by any historical standard. And extraordinary moves create extraordinary positioning. This is the part that most people miss. It is not enough to understand what an asset is worth in fundamental terms. You also have to understand who is holding it, how they are holding it, and what would force them to sell. Because in modern markets, positioning determines short-term price action far more than fundamentals do. By mid-January 2026, the precious metals trade had become what professionals call crowded. Sentiment indices showed that positioning in gold was at an 8-year high. Retail investors were pouring money into silver ETFs and physical bullion at record rates. Managed money, the category that includes hedge funds and algorithmic trading systems, had built large net long positions in both gold and silver futures. The trade was consensus. Everyone was on the same side of the boat. This is where the system's mechanical vulnerabilities become relevant. When a trade is crowded, it does not take a fundamental change to trigger a reversal. It takes a positioning change. And positioning changes create cascading effects that can move prices far beyond what fundamentals justify. On January 30th, the CME Group announced maintenance margin increases of 36% for silver futures and 33% for gold futures. This is a mechanical action. When margins increase, traders who are holding leverage positions must either deposit additional capital or reduce their positions. Many choose to reduce. The selling creates downward price pressure. The downward price pressure triggers stop-loss orders from other traders. The stop-losses create more selling. The cascade feeds on itself. This alone would have been enough to cause a significant correction, but it was not the only catalyst. On January 29th, President Trump announced that Kevin Warsh would be his nominee to serve as the next chairman of the Federal Reserve. Warsh is widely viewed as a hawkish institutionalist. His nomination signaled to the market that the era of easy monetary policy might end sooner than expected. The dollar index surged in response, and since gold and silver are priced in dollars, a stronger dollar mechanically pushes their dollar price lower, even if nothing has changed about the metal itself. The combination of margin hikes and the Warsh nomination created a 1-2 punch that hit a crowded market at its most vulnerable point. The selling that followed was not driven by any change in physical supply or demand. It was driven by positioning mechanics, margin calls, stop losses, algorithmic triggers, and forced liquidation. This is the critical distinction that most commentary on this event misses entirely. The crash was real, the losses were real, but the cause was not a change in what silver is worth. The cause was a change in who was holding it and how they were holding it. Leveraged longs were forced out. Algorithmic systems detected the momentum shift and added sell pressure. Margin calls forced liquidation across correlated assets, which is why Bitcoin, Korean tech stocks, and precious metals all fell simultaneously. The selling was mechanical, not fundamental, and here is where the physical market response becomes genuinely significant, because while the paper market was liquidating positions, the physical market was doing the exact opposite. The Perth Mint suspension of wholesale orders was announced before the crash, when silver was still at $117. They were already overwhelmed by demand at higher prices. When the price dropped 22%, demand did not decrease, it intensified. Every informed physical buyer in the world recognized the crash for what it was, a paper-driven event creating a discount on a product that was already in shortage. The US Mint's response was even more revealing. They suspended sales entirely, then repriced their products 86% higher when they resumed. This tells you that the Mint itself did not believe the paper price reflected the actual cost of producing and delivering physical silver. If the paper price were the real price, an 86% markup would be absurd. But the Mint understood that the paper price and the physical price were no longer the same thing. The Indian market's response was the most dramatic. Dealers defaulting on deliveries is not a supply hiccup, it is a breakdown in the delivery system itself. When a dealer takes your money and cannot give you the product, the market has crossed a threshold from tight supply into systemic failure. And then there is China. This is the part of the story that deserves the most attention, not because it is alarming, but because it reveals the clearest expression of strategic behavior in the entire episode. China has classified silver as a strategic national security asset. They have restricted silver exports. They are treating silver the same way they treat rare earth minerals, as a resource with military and technological implications that justifies government control over its distribution. And while the paper price was crashing, Chinese entities were taking physical delivery from the Shanghai exchange at an accelerating rate, 27 tons in a single day. Now let us be precise about what this means and what it does not mean. It does not mean China knows something secret about silver's future price. It means China is behaving according to its stated strategic priorities. They need silver for solar panel manufacturing, for electronics, for their industrial base. They have decided that securing physical supply is more important than the current price. They are acting on their industrial policy, not on a market thesis. But the effect is the same regardless of the motivation. Physical metal is leaving the visible inventory system and moving into strategic reserves where it is unlikely to return to the open market. This reduces the buffer that has been covering the annual deficit. It accelerates the timeline toward the point where the system has no slack left. This is the pattern that actually matters. Not the daily price movement, but the structural shift in where physical metal resides and who controls it. Metal is moving from west to east, from financial vaults where it serves as collateral for paper trading to industrial and strategic reserves where it serves a physical function. Every ounce that makes this journey reduces the ability of the paper market to function as a price-setting mechanism. Now let us examine the other actors in this system, because each one is operating according to a different logic, and understanding those logics is essential to understanding where this goes next. The United States financial system has a specific relationship with precious metals that is different from every other country's relationship. The dollar is the world's reserve currency. Gold and silver, when they rise sharply against the dollar, send a signal that the market interprets as a loss of confidence in the currency. This creates an institutional incentive to manage the pace and magnitude of precious metal price increases, not necessarily to suppress them permanently, but to prevent disorderly moves that could destabilize broader market confidence. The CME margin increases should be understood in this context. They are not illegal, they are not secret, they are a standard tool that exchanges use to manage volatility, but the timing and magnitude of their deployment is a policy choice, and that choice has consequences. Raising margins by 36% on silver futures when positions are already at extreme levels is the equivalent of pulling a fire alarm in a crowded theater. Everyone runs for the exits at once. The question is whether this represents manipulation or prudent risk management, and the honest answer is that it can be both simultaneously. The exchange has a legitimate interest in managing systemic risk. Traders who are over-leveraged pose a risk not just to themselves but to the entire clearing system. But the timing of margin increases, always at the peak of upward moves rather than during downward moves, reveals a directional preference that is difficult to attribute entirely to neutral risk management. The European central banking system presents a different picture. European central banks have been net holders of gold for decades, and their holdings are substantial. But Europe's relationship with precious metals is passive rather than strategic. They hold gold because they have always held gold, not because they are actively accumulating as a hedge against dollar depreciation. Europe is a passenger in this story, not a driver. Russia occupies a unique position. Western sanctions have effectively excluded Russia from the dollar-based financial system, which means Russian institutions cannot participate in dollar-denominated commodity markets in the same way they could before 2022. This has pushed Russia toward alternative settlement mechanisms, including gold-based trade settlement with China and other partners. Russia's gold reserves serve a functional purpose in this context. They enable trade that would otherwise be impossible under sanctions. The broader global south faces a different version of the same dilemma. Countries like India, Brazil, Turkey, and the Gulf states are watching the paper-physical disconnect in silver and drawing conclusions about the reliability of Western commodity pricing mechanisms. If the price set in New York can diverge this dramatically from physical reality, what does that say about the integrity of the pricing system as a whole? This question extends beyond silver to every commodity price through Western financial infrastructure, oil, copper, wheat, all of it. This is the deeper significance of what happened in January 2026. It is not really about silver. It is about the credibility of a pricing architecture that the global economy depends on. When paper and physical diverge, it raises a question that has implications far beyond any single commodity. Can a system where paper trading volume exceeds physical supply by orders of magnitude continue to set reliable prices? The answer until recently has been yes, because the paper system worked well enough that most participants accepted it. But acceptance is not the same as trust, and the events of late January tested that acceptance in ways that will not be easily forgotten. Now let us talk about what the lease rate data actually tells us, because this is the most technically precise signal in the entire situation. Silver lease rates represent the cost of borrowing physical silver. In normal market conditions, these rates hover between 0.3% and 0.5%. They are low because there is adequate supply of lendable metal. When someone needs to borrow silver, whether to cover a short position, meet a delivery obligation, or satisfy an industrial requirement, they can find willing lenders at minimal cost. In late January, silver lease rates spiked to levels that have not been seen in the modern era. Reports showed rates between 8% and 39% depending on the duration and the counterparty. A 39% lease rate means that borrowing silver for a year would cost 39% of its value. That is an extraordinary number. It means that holders of physical silver are either unwilling to lend it or are demanding compensation that reflects extreme scarcity. This signal is difficult to manipulate. Lease rates are set by bilateral negotiation between borrowers and lenders of actual physical metal. They cannot be manufactured by trading paper contracts. When lease rates spike, it is because real borrowers are competing for real metal that real lenders are reluctant to part with. It is the closest thing to a pure supply-demand signal that exists in the precious metals complex. And it directly contradicts the message sent by the paper price. The paper price says silver is abundant, that supply exceeds demand, that the correct price is lower. The lease rate says the opposite. It says physical silver is so scarce that borrowing it costs more than borrowing money from the most expensive credit card on the market. One of these signals reflects trading flows, the other reflects physical reality. The tension between them is the defining feature of this market. Now, let me address the question that most people are actually asking, even if they frame it differently. What happens next? I am not going to give you a price target. I am not going to tell you silver goes to $150 or $200 or $300. That would be speculation dressed up as analysis, and that is not what this channel does. What I can do is outline the structural forces at work and describe the scenarios that emerge from them. There are 3 scenarios that deserve serious consideration. The first is a managed resolution. In this scenario, the paper-physical disconnect narrows because physical demand moderates and paper prices stabilize at a higher level than before the crash but lower than the January peak. Mines increase production in response to higher prices. Recycling activity picks up as holders sell into strength. The deficit narrows, inventories stabilize. The system absorbs the shock and continues functioning, perhaps with higher premiums and longer delivery times, but without a systemic breakdown. This is the scenario that institutional analysts prefer because it preserves the existing market structure. The second is an accelerating disconnect. In this scenario, the forces that drove the January divergence intensify rather than moderate. Central bank and sovereign purchases continue at elevated rates. Industrial demand for silver, particularly from the solar energy sector, continues to grow. Mine production fails to respond meaningfully because new mines take 7 to 10 years to develop. The deficit widens. Inventories continue to decline. Physical premiums expand to the point where the paper price becomes largely irrelevant for physical transactions. This scenario does not require a conspiracy. It only requires that current trends continue at their current pace. The third is a systemic disruption. In this scenario, a delivery failure at a major exchange triggers a cascade of counterparty defaults. Futures contracts that were assumed to be cash settled are suddenly demanded for physical delivery, and the exchange cannot deliver. The exchange declares force majeure, settling contracts in cash at prices that may or may not reflect physical reality. The credibility of the futures market as a price-setting mechanism collapses. Physical silver trades at whatever price bilateral negotiation produces, potentially at dramatic premiums to the last paper price. This scenario is the least likely but the most consequential. Each of these scenarios has different implications, and the probability weights shift depending on variables that are genuinely uncertain. Will the Walsh-led Federal Reserve maintain higher rates, strengthening the dollar and pressuring metals prices? Will China's industrial demand continue to grow, or will an economic slowdown reduce consumption? Will the BRICS payment system develop into a real alternative that accelerates de-dollarization, or will it remain a marginal experiment? These are the questions that determine where this goes. Not the daily price chart. Not the breathless commentary about manipulation, not the predictions about price targets that are designed to generate clicks rather than understanding. The February massacre, as the market is calling it, was not the end of a story. It was a stress test, and what the stress test revealed is that the infrastructure connecting paper prices to physical reality has degraded to the point where a single week of volatility can cause mints on 3 continents to suspend operations simultaneously. That is a system-level finding. It tells you something about the architecture, not just about silver. It tells you that the pricing mechanisms we depend on for all commodities, the futures exchanges, the clearinghouses, the derivative structures, are built on assumptions about the relationship between paper and physical that may no longer hold. Whether you hold silver or have no interest in ever owning an ounce of it, this matters to you. Because the same architecture prices your food, your fuel, your building materials, and the inputs that make every product in your daily life. If the pricing mechanism can break for silver, it can break for anything. And that is the question that actually matters. Not whether silver goes to 150 or drops to 70, but whether the system that prices the physical world through paper abstractions can sustain the growing gap between the two. For 55 years since Nixon closed the gold window, we have been running an experiment. The experiment is whether a financial system built on paper promises can accurately price and allocate physical resources indefinitely. For most of that period, the experiment appeared to work. The paper system was efficient, liquid, and broadly accepted. But the events of January 2026 suggest that the experiment is entering a new phase. A phase where the gap between paper and physical is no longer a theoretical concern discussed in academic papers, but a practical reality that shuts down mints, drains vaults, and forces dealers to default on their customers. The people who sold paper silver during the crash and the people who bought physical silver during the crash are not just making different trades, they are expressing different beliefs about how the world works. One group believes that the paper system will continue to set prices and that short-term trading profits are what matter. The other group believes that physical possession of scarce resources is what matters and that paper prices are a temporary distortion. History does not tell us which group is right in the short term. Paper markets can maintain price suppression for longer than most physical buyers expect, but history does tell us something about the long term. In every instance where paper claims on a physical asset exceeded the physical supply of that asset by a sufficient margin, the resolution was the same. The paper price eventually converged with physical reality, sometimes gradually, sometimes violently, but always in the same direction. The flow of money in this particular market is moving in two directions simultaneously. Paper money is flowing out of precious metals positions in the West, driven by margin calls, algorithmic selling, and the expectation of a stronger dollar under a hawkish Fed. Physical metal is flowing into vaults, safes, and strategic reserves in the East, driven by industrial demand, central bank accumulation, and a growing distrust of paper pricing mechanisms. These two flows will eventually resolve into one. The question is which direction the resolution takes, and the answer to that question depends not on what any individual trader does, but on whether the physical world has enough silver to meet the physical world's demand. The numbers suggest it does not at current production levels, not at current consumption rates, not with current inventory levels, but the paper market disagrees, and the paper market for now still sets the price. That tension between the physical reality and the paper abstraction is the single most important dynamic in commodity markets today. It extends beyond silver to copper, to rare earth minerals, to energy, to agricultural commodities. It is the tension between a financial system designed for infinite expandability and a physical world defined by finite resources. You do not need to own silver to understand why this matters. You need to understand it because it tells you something fundamental about the system you live in. A system where the price on your screen and the reality in the warehouse can move in opposite directions. A system where a crash in price coexists with a shortage of product. A system where the people selling have never touched the asset and the people buying cannot find it. That is not a market failure in the traditional sense. The market is functioning exactly as it was designed to function. Paper trades paper, physical trades physical, and the assumption that they are the same thing is the assumption that is being tested right now. The real question is not whether silver will go up or down next week. The real question is whether a pricing system built on paper abstraction can survive contact with physical scarcity. And that is a question that extends far beyond any single commodity, any single trade, or any single crash. It is a question about the architecture of the global financial system itself. The flow of money is telling you something, not shouting, not screaming, just quietly, persistently, flowing in a direction that paper prices are trying very hard to ignore. Pay attention to the flow, not to the noise.